Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at energy fuels.
If you find our talks useful, please consider subscribe, like, and comment underneath, because today's focus is incredibly timely, honestly.
Yeah, it really is. We are basically looking for a, completely de-risked option within this massive nuclear renaissance that's happening right now.
Right, which is just everywhere in the news lately.
Exactly. So today we are tracking an 8.5 out of 10 bullish investment thesis for a company that isn't just riding a commodity wave. They are fundamentally restructuring their entire business to become a multi-commodity critical minerals leader.
Okay, but there is this massive glaring contradiction here that makes this whole analysis so fascinating to me. I mean, they absolutely crushed their 2025 uranium sales goals,
Not
right?
big time, yeah.
But then they turn around and report an $86.1 million net loss, which just sounds insane.
Yeah, it's definitely a number that makes you do a double take.
It really does. So the mission for today's discussion is to basically unpack why that huge loss is actually a strategic war chest maneuver. And we want to figure out why the stock might be lagging a massive breakout in the underlying commodity.
Right, because to really understand that paper loss, you first have to look at the macro environment they're operating in. Spot uranium prices have just completely broken out.
Totally. It's been a wild ride.
Yeah, we're talking about prices touching over $100 per pound recently.
Which is a huge jump from earlier this year, right? Because the average spot price was sitting around, what, $89?
Exactly, around 89. That is a violent upward swing in the commodities market. And energy fuels clearly saw that jump coming. I mean, looking at their 2025 performance, they sold 650,000 pounds of uranium.
Wow.
Yeah, and that generated $48.2 million in revenue. Now, their revised guidance, like their own internal target, was only to sell 350,000 pounds.
Wait, so they practically doubled their own target?
They did. It blew their guidance out of the water. It just proves management can instantly pivot and capture sudden market opportunities.
Okay, but here's the obvious pushback. If spot prices are surging like that, and they sold nearly double their target volume, how on earth do you report a net loss of $86.1 million? I mean, that's 38 cents a share.
I know, it looks like a catastrophic failure if you only glance at the top line numbers.
Right. It feels like opening a lemonade stand during a brutal heat wave, right?
Yeah.
You sell out of every single drop of lemonade at a massive markup,
Yeah.
and you somehow still go bankrupt at the end of the day.
That is a great analogy, but let's adjust it just a bit. Imagine you sell at a lemonade during that heat wave, and instead of taking your profits home, you immediately buy the massive lemon orchard next door.
Oh, okay.
And then you buy a sugarcane field across the street. And then you hire a team of lawyers to integrate those properties and deal with international property taxes. That loss we are seeing is a feature, not a bug. It's just strategic expansion.
So it's the literal cost of being aggressive and forward-looking. But what exactly did they spend $86 million on in a single quarter?
Well, if you peel back the layers of the loss, it breaks down into very specific non-recurring investments. For example, there's a $15 million increase in their SG&A, their selling, general, and administrative expenses.
Right, their corporate overhead, basically.
Exactly. And this wasn't because management suddenly bought private jets. It is the direct mechanical result of their acquisition of base resources. When you buy a massive international company, your overhead is going to temporarily balloon.
Because you're paying for, legal integration and severance packages and all that.
Yeah, all the banking fees, the system mergers, exactly.
Okay, and I also noticed this highly specific $6.9 million charge that was strictly related to tax law changes in Madagascar.
Right, because Base Resources operates in Madagascar. When you expand your global footprint, you absorb the friction of local tax jurisdiction changes.
That makes a lot of sense.
So energy fuels is absorbing all these costs right now, taking the hit on paper while the macro environment is super favorable. They're building out a global infrastructure.
And that infrastructure is built on top of some incredibly strong competitive moats, right? Which is what makes this whole setup so compelling to me. Let's look at their first major structural advantage, the White Mesa Mill in Utah.
Oh, yeah. The White Mesa Mill is basically the crown jewel of their portfolio. It is the only licensed and operating conventional uranium mill in the United States.
Wait, the only one?
Literally the only one.
See, I used to think of a mill as just, a big industrial warehouse with some crushers and chemical vats. But a conventional uranium mill is a completely different beast.
It really is. The barriers to entry are just incredibly high.
I would compare owning the White Mesa Mill to owning the only toll booth on a highly profitable, heavily trafficked highway. Like anyone who wants to drive, or in this case, process alternate feed materials, they have to pay your rate.
That is precisely why it is such a massive moat. Think about the current regulatory environment. If you wanted to build a new conventional uranium mill from scratch today, you are looking at a decade or more of environmental impact studies.
Oh, easily a decade, plus all the community pushback.
Exactly. And billions of dollars in capital expenditure with absolutely no guarantee the government will ever grant you the final permits, but Energy Fuels already has it up and running.
So they essentially control the regulatory bottleneck.
They do. And having that exclusive processing capability feeds directly into their second major moat, which is the Pinyon Plain mine. Because you can't just process materials, you need high-quality feed for that mill.
Right, and the Pinyon Plain mine is providing exactly that. It's emerging as one of the highest-grade uranium mines in U.S. history, isn't it?
It is. The filings note an average grade of approximately 1.62%.
And for anyone listening who isn't, reading mining journals every weekend, a 1.62% grade might sound tiny. But in uranium mining, where companies are extracting ore with grades of like 0.1%, 1.62% is incredibly dense.
It's massive. It completely changes the physical mechanics of the operation. Because the ore is so concentrated, you don't have to blast and haul millions of tons of useless waste rock.
Oh, I see. So you run fewer trucks, use less diesel.
Exactly. Fewer chemical reagents in the milling process, fewer man-hours. This extreme efficiency is driving their all-in projected production costs down to approximately $23 to $30 per pound.
Wait, let me just make sure I have that math right. So their cost is around $25, and we just established that the spot market price recently crossed $100.
Yeah, you got it.
That margin is just massive. That kind of markup fundamentally changes a company's balance sheet, which perfectly explains this genuinely jaw-dropping working capital number we're seeing.
The fortress balance sheet, it's wild.
Yeah. As of December 31st, 2025, they have $927.4 million in working capital.
Nearly $1 billion in liquidity.
It's insane. It includes $64.7 million in cold cash and a massive $797.1 million portfolio of marketable securities. But where did this mountain of capital actually come from? Because it wasn't just cash from operations, right?
No, it wasn't. They bolstered this position with a $700 million upsized offering of convertible senior notes that are due in 2031.
Okay, but the interest rate on those notes is what really stops you in your tracks. It's 0.75%.
It is essentially free money.
In a world where standard corporate debt can easily run 5, 6, or 7%, convincing institutional investors to hand over $700 million for less than 1% interest is staggering. Why would any rational institution agree to those terms?
Because of the underlying mechanics of a convertible note. These institutional investors are basically saying, we will give you $700 million for practically zero interest, just for the privilege of converting this debt into your stock at a locked-in price later.
Oh, wow. So they're willing to forego millions in traditional interest payments.
Exactly, because they are making a massive, calculated bet that the underlying stock price of Energy Fuels is going to explode. The equity upside is worth far more to them than a standard 5% yield.
It's the ultimate vote of confidence from the smart money.
Yeah.
But that brings us to the real strategic pivot here, which is kind of controversial. What is the plan for this billion-dollar war chest?
They are using it to fund the proposed acquisition of Australian Strategic Materials ASM and to rapidly expand their Phase 2 rare earth element circuit.
So they're pivoting to rare earths.
Yes, and by funding these multi-billion-dollar expansions through their existing low-interest war chest, they avoid diluting equity. They don't have to issue new stock at current depressed share prices.
But wait, if uranium is a total gold mine right now, literally yielding that massive profit margin we just talked about, why on earth are they pivoting heavy capital into rare earth elements?
It's a fair question, and it's the exact bear case out there right now.
Because I've seen headlines warning about a rare earth funding boom that's inevitably going to cause a market glut, right? We've seen this cycle before. A material gets hot, everyone rushes to dig it up, there's massive oversupply, and the price just craters. Aren't they taking their eye off the ball here?
The execution risk on diversifying into a new commodity class is undeniably real. But if you look at the underlying math, Energy Fuels is actively de-risking this pivot by engineering an incredible incredibly low-cost floor.
Okay, how low are we talking?
Well, even in a lower price environment or a market glut, they are projecting their processing costs at just $29.39 per kilogram for NdPr equivalent.
Let's clarify NdPr for a second. We are talking about neodymium and praseodymium, right?
Yes, these are the highly specific, incredibly critical magnetic elements that you absolutely must have to build high-performance electric motors in an EV or the massive turbines in a wind farm.
Right. You basically cannot execute a global energy transition without NdPr.
Exactly. And by anchoring their processing costs at roughly $29 per kilogram, they are ensuring they remain profitable even if a global supply glut forces market prices way down. They're heavily protecting their bottom line.
And there is a geopolitical layer to this that goes far beyond just spot prices. Energy Fuels isn't just selling NdPr, they're selling Western supply chain security.
That is a huge point. The Western world is currently completely dependent on overseas monopolies, specifically in Asia, for these critical minerals. Energy Fuels is stepping up to become the indispensable, domestically secure alternative.
Because when auto manufacturers and defense contractors are sourcing materials, they aren't just looking for the cheapest price anymore. They want a supply chain that won't be weaponized during a crisis.
Exactly, which perfectly aligns with the massive macro policy tailwinds we are seeing right now.
Oh, absolutely. I mean, financial headlines are screaming about nuclear energy stocks rallying. But beyond the typical market hype, there is heavy structural government support coming in. The White House recently established the National Initiative for American Space Nuclear Power.
Yeah, and you really have to pause and consider the implications of a mandate like that. The government isn't just putting out a press release saying they generally support nuclear energy.
Right.
They are directly mandating the establishment of a robust domestic uranium supply chain to fuel future space operations. This isn't theoretical demand. This is a mandate from the U.S. government locking in long-term demand.
So, from an investment perspective, you have a company sitting on massive profit margins, a billion-dollar liquidity war chest, a monopoly on domestic processing, and federal mandates driving future demand. But there is a crucial detail for the timeline here. Just 2 days ago, on April 15, 2026, there was a major changing of the guard at the executive level.
Yes, a massive shift. The founder of the company, Mark Chalmers, officially transitioned into a consultant role, and Ross Papu took over as the new CEO.
Why does that specific shift matter so much to investors?
You cannot overstate how important this transition is to the institutional market. Mark Chalmers is a mining engineer. He fits the classic founder archetype, the visionary who gets his boots dirty and builds the physical infrastructure from the ground up.
Right, the guy who builds the machine.
Exactly. But moving from an engineer founder to a strategic corporate leader like Ross signals a completely new phase in the company's life cycle. It's the evolution from building the machine to optimizing the machine.
Well, that makes total sense. It signals stability.
It signals maturity and the institutionalization of the business model. When massive institutional investors look to take a major position, they want a predictable corporate structure. This seamless succession attracts the smart money.
Okay, so we've covered the financials, the structural moats, the macro policy shifts, and the leadership transition. Let's bring this all the way down to the ground. If you're a listener tracking this, what exactly does the catalyst calendar look like for the next 3 months?
The immediate roadmap is actually highly actionable. First, you have Q1 2026 earnings coming out in May.
Okay, so what should people be looking for in that report?
You specifically want to watch for significant upward revisions to their forward revenue guidance. Because spot prices recently crossed that $100 per pound threshold, the market needs to see exactly how much of that premium pricing Energy Fuels managed to lock into their new sales contracts.
Right, getting those high prices officially on the books.
Exactly. And the second major catalyst the market is waiting on is a Form 8K filing to officially confirm the final closing of the ASM acquisition.
Because right now, Wall Street hasn't fully priced in the value of that deal, have they?
Not at all. The combined rare earth project has an estimated net present value of $3.7 billion. But because of execution risk, the market is treating that valuation with deep skepticism.
But the moment that official close happens and the 8K hits the wire,
it acts as a massive re-rating catalyst. The uncertainty vanishes, and the stock price mathematically has to adjust to reflect that legally secured value.
Wow. So distilling all of these financial mechanisms into a single thesis, what's the elevator pitch here?
The bottom line is an 8.5 out of 10 bullish rating. The strategic play is to treat Energy Fuels as a long-term core holding target, operating on a 12 to 24-month horizon.
Okay, so hold through the short-term volatility.
Yeah, hold through the ASM acquisition close and the realization of their massive 2026 uranium sales contracts. The fundamental beauty here is that the extreme free cash flow from their uranium monopoly is more than enough to self-fund their entire multi-billion-dollar pivot into rare earths.
So they're essentially getting a second globally critical business line fully paid for by the phenomenal margins of their first. It's just a masterclass in capital allocation.
It really is.
Well, as we wrap up today, I want to leave you all with a final, slightly provocative thought to turn over in your mind. Traditionally, when we think of mining companies, we think of an old world, deeply terrestrial industry, right? It's dirt, heavy diesel trucks, and massive holes in the ground.
Yeah, very earthbound.
But when you look at these new federal initiatives, specifically demanding space nuclear power, the paradigm shifts entirely. The highly concentrated resources being pulled out of the Pinyon Plain mine aren't just fueling local power grids anymore. They are literally becoming the foundational infrastructure, the raw propulsion fuel for humanity's next chapter in space exploration.
It completely changes the end use of the product.
Precisely. When a traditional dirt-digging mining company essentially evolves into a vital aerospace fuel provider, how does that fundamentally change the way we value the rocks they pull out of the ground? It is no longer just a localized commodity, it's the physical key to the next frontier. Thank you so much for joining us today. Keep reading, keep analyzing, and above all, keep questioning the consensus.